Hello, everyone. Welcome to episode 20. Now, stablecoins are everywhere in the headlines, and every financial platform is racing to integrate them into their products. But I have this one question that I keep coming back to. What if merchants don't accept stablecoin payments? Why would people actually use them? And beyond cross border remittances, I'm not seeing any movement either in fintech or merchant level. What do you think about this, Romeo?
A lot of founders are asking the same questions and trying to answer this specific question through a superior product. But the problem is, I don't think that a better stablecoin is the answer to the distribution problem. Because right now, you can think of this moment as we are experiencing a sort of a Cambrian explosion in the finance space. There are a lot of new emerging players that are coming into the market with a wide array of products and services. But the path to mass adoption is not it's not a function of inventing a better stablecoin or a faster blockchain. But we have to solve this classic two-sided market problem that we are experiencing, and that the one that you were mentioning, which is merchants will not accept payment method that a consumer don't use, and consumers will not use a payment method that merchants don't accept. Right. So this is basically your classic chicken and egg problem. So what we have seen so far is like the history of payment innovation. If you take a look at it, like technical superiority has never been the most important part of the equation. uh, like technical superiority alone, it's insufficient. You don't get to a point where you dominate the market through just a better platform. What you need is like, for example, credit card networks. They like everyone suddenly did not start using credit cards because like they were the best product that there is in the market, but
Right.
they created this robust ecosystem with incentives, tools. They put in support systems, and they basically infiltrated every single merchant that they could find in any commercial region, right? So that's why credit cards and then later debit cards become such a huge deal. Went to such a mainstream extent that now everyone, literally everyone in the developed world and even in the developing world, have a credit card, have a debit card, right? um, so how do you get to that point? Like, how do you go mainstream with stable coins? From where I stand, how I see it is like you need to have three things. You need merchants need to accept it, and you need to have efficient ways to onboard and offboard. Like for example, for stablecoins to be useful, you must be able to integrate cleanly with fiat on ramps, like for example
Mhm.
bank deposits or card purchases. And you need to also be able to off ramp easily, like for easily with, let's say, with the ATM withdrawals, direct deposits, etc. So these are obviously these are areas that consumers and businesses are already very familiar with. And at the end, you need to build that level of user experience and trust. Like a trust is a major part of the whole crypto experience.
Right.
Many consumers, they still don't understand stablecoins, and they confuse stablecoins with the volatility of other cryptocurrencies. And so the trust factor is pretty low. And obviously, like if you look at stablecoins or basically crypto in general, how I see it is like it's definitely not something that it's easy to use. It's not, right? So we need to figure it out in a way that we need to create, like, have outlets, have stablecoin products and crypto products that are much easier, like much more seamless to use. So these are the three primary problems. So I solve three of them, and we have basically have a mainstream stablecoin product. People are familiar with stablecoins. They are using it for their daily payments, and yeah, that's pretty much.
And do you think networks like Swift, ACH, and other legacy rails will step up their game and try to compete with stablecoin rails?
I mean, I think it's a bit too late for that, because stable coins are just an emerging product. But like Swift has been there since the 1970s. There has been like these legacy rails, they have been iterated upon and innovated to the maximum extent, I think. And the finished product that we have, it's incredibly inefficient. Like if you look at these methods, like corresponding banking, you have the ACH system, whatever, like international banking, domestic banking. You will see high cost of settlement. You'll extremely slow settlement, in terms of when you issue the payment and when the payment ultimately reaches the recipient. And obviously then you also have like operational friction. Like just to give you an example of the high cost, like something that I have been beating this drum for since the very first episode that we have done is like a single international wire transfer. Let's say you process it via Swift network, and it passes through multiple correspondent banks, right, before it reaches the destination. And every single intermediary will charge you like $10 to $30 per transaction. And when you combine that with the originating and receiving bank fees, a single wire can cost you up to, I don't know, $50. And that's just not all. That on top of that, you have got like foreign exchange conversion fees, which can add an additional 1% to 3%. You have got card network fees that includes like interchange, and they also charge the market, right? So if you can bypass this entire chain of intermediaries, like stablecoins can go direct. They can enable peer-to-peer transactions that can reduce costs, just like from $50 to $70 to just a few cents. That's just the gas fees and whatever fees you are paying to the on-ramp off-ramp mechanism, so that you are using, right? And then you have got the slow settlement problem. Like these transactions, they are constrained by like batch processing, and then the standard banking hours. They have weekends and national holidays. They have the settlement of funds is extremely slow, right? And like for example, an international wire transfer, it will take you, like routinely it takes you anywhere from 2 to 5 business days to complete. And even in some cases, like domestic ACH transfers might take you, like if you're processing something on the weekend, it might take you 1 to 3 days. uh, so this and the problem is, like if you are a business, it creates this settlement lag, or like this significant working capital inefficiency for businesses. Like your vendor payment gets delayed, your supply chain gets disrupted, you're basically forcing companies to hold like unnecessary amount of large cash buffers. So yeah, not definitely not an optimal way to do business. And on top of that, you have this like this reconciliation gap, which is like the same thing but in terms of accounting. Like for example, like imagine like there is there's a company that sees that they have received a payment 2 days ago, or they have issued a payment 2 days ago, and officially the payment is done, right? They should have the money. Either they should have their vendor should have the money, or they should have received the money, and the product or the order should have been processed by them, because they had processed the payment 2 days ago. But since banking takes another 2, 3, 4 days, there is an inherent mismatch between their operational procedure and their accounting procedure. And if those two are on two completely different pages, then how do you imagine your business is running, right? It's running abysmally. So how do you create distribution? Do stablecoin companies go out there and start to like try to create something, try to create something similar to Visa or Mastercard, and basically compete against Visa and Mastercard directly? I don't think that's the solution. I don't think it's going to be of much use to try to compete against Visa or Mastercard, because they are gigantic payment platforms in their own right, and they control a huge amount of the global payment process, like total payment processed in the world right now. And the good news is, like Visa and Mastercard, they are not viewing stablecoin as a threat to their dominance, but they're looking at it as sort of like a technological revolution. It's moving the same money that they help move. So their strategy is, right now, from where I stand, I'm seeing them like act in two ways. First of all, they are trying to enable consumers to spend stablecoins at their millions of merchant locations that they already have in their network. And they're also trying to upgrade their own backend settlement system to use stable coins for more efficient treasury operations, right? For example, Visa has been like the most proactive company in terms of adopting stablecoins. Visa was one of the first major payment networks to pilot a settlement transaction using stablecoins. Like they partnered with Anchorage Digital, and then basically created this crypto native. Like they partnered with crypto native companies like Crypto.com to settle their obligations to Visa directly using USDC on Ethereum, right? And since then, they said that they have expanded a lot. Right now, there's like their settlement platform now supports like a number of different blockchains like Ethereum, Solana, Stellar, Avalanche. And they have basically a growing roster of trusted regulated stablecoins like USDC, PayPal USD, Global Dollar, Euroback EURC, and etc. So yeah, like Visa understands the promise of stablecoin, and they're doing their best to become like the strongest entity entity in the payment space by effectively adopting stablecoins as in their suite of core products. Like right now, they're facilitating issuance of stablecoin linked cards. These cards will allow users to pay at any time at over like 150 billion merchant locations that Visa has in the network. And the stablecoin balance will be converted to fiat currency at the point of sale directly. So this effectively creates a universal global off ramp for stablecoin holders. Visa is trying to say, you want to use stablecoins, like come on to Visa and use ours
Right.
that we have already created, right? And Mastercard is also going in a similar route, slightly differently. I think what they are trying to do is they're trying to build a comprehensive end-to-end stablecoin transaction ecosystem that encompasses consumers, merchants, and underlying infrastructures. They have partnered with payment processors like Nuvei and stablecoin issuers like USDC, Paxos, to give merchants the option to receive payments directly in stablecoins, right? And also they are also partnering with like crypto native exchanges, for example, OKX, Kraken, I think Binance as well. And also also wallet providers like MetaMask to issue cards that allow users to spend stablecoin holdings across basically Mastercard's global merchant network that they have. And they're also facilitating the conversion of stablecoins like back into bank accounts through Mastercard's Move suite of money movement solutions. So that's
So
where.
wait, I get your point on like card networks, but if we look at what happened in India with UPI, it like basically wiped out the debit card network, and now credit cards are trying their best to adopt UPI to become more frictionless. Why can't the same thing happen elsewhere in the world?
I think that's actually a pretty good point. So from where I stand, I see the Indian experiment with UPI has been extremely successful, especially since it has been like entirely government backed and not something that was inspired privately. But at the same time, like the financial market is in India is extremely slow, extremely like not slow, it's extremely small in size compared to the US. I think the US market is like 10 to 15 times bigger in terms of credit card settlement or debit card settlement. But I take your point. Like, for example, back in 2019, India was processing about 455 million debit card POS transactions every month. And after the UPI system came in place in the March of 2025, we are at about like 90 million per month. So that's about 80% down from its peak. That basically means the UPI system has essentially obliterated the debit card market that we have. But like when you take a look at the US numbers, in US there are 2.63 billion transactions that happen with credit cards every single month. And this is actually data from 2022. So I would assume right now it's about anywhere 20 to 30% higher than what the numbers that I currently have. And in terms of debit card, that number is like 5.02 billion transactions per month on the debit card side. So the market in the US is simply 10 to 15x bigger in size, and it's extremely difficult to compete against such a vast and well established network. Like even if an UPI like system makes the consumer to merchant payment flow much more frictionless, the incentives are simply not there to disrupt the payment market, like let's say by trying to compete with giants of the financial services. You simply can't imagine to win against like Visa, Mastercard, Worldpay, and people entities like this. So yeah, that's the like in smaller economies. I mean, yeah, sure. Like in the smaller European countries, definitely in Latin America and in Africa, like where credit card and debit card companies are still trying to gain a foothold in these like developing world economies. I think stablecoin, like native stablecoin settlement services, are going to win this race. Now the question is, will Visa or Mastercard like have their own stablecoin? I don't know, like a PO direct to a stablecoin settlement service like UPI system, or like what they have in Brazil's. I think it's called the PRIX system. I don't know. Maybe if they do, they will have two products to compete with. I mentioned Worldpay. Actually, let me talk about Worldpay for a little bit. Worldpay is the world's largest payment processor, and they have actually emerged as one of the most aggressive adopters of a stablecoin. Like they are doing their best to get into this game. They have like partnered with Fireblocks. They're trying to offer like settlement in stablecoins in real time. Traditionally, obviously, merchants will have to wait 3 or more days to receive your funds through the card transactions. But with WorldPay, they're trying to settle instantly. With I think they are working with on USDC and USDG on Solana. So that will be an interesting attempt at adopting stablecoins from WorldPay. And obviously, similarly, we have discussed Stripe for like in the last few episodes that they have essentially launched a suite of products, not mentioning Tempo, like just a Stripe in general. They have enabled their US-based business clients to accept stablecoin payments from customers globally, including checkout, payment links, elements, etc., etc. And they have also like they are trying to solve this recurring payment problem. Like they have essentially developed this solution for recurring stablecoin payments. Like one of the primary limitation of blockchain payments is that every single transaction has to be manually signed and authorized. So what they're trying to do right now is they have created a custom smart contract that allows customers to authorize their wallets to make recurring payments. So every single month, you send money to your vendors without having to manually verify or sign every single transaction, which will be helpful for merchants that have recurring payments, which is basically every single merchant in the world, right? And moving on from Stripe, we have got Shopify. Shopify partnered with Coinbase Payments, and since then they have enabled USDC payments for eligible merchants using Shopify payments. And merchants can choose to have their USDC payments automatically converted and paid out in their local currency, or they can alternatively opt to receive and hold the USDC in their wallet, in their best Shopify wallet, and they can then get it out to an external crypto wallet. And the reason that I'm mentioning these companies is that they already have a set number of networks, like an established network of point of sale transactions. And like point of sale, Visa and Mastercard has got point of sale, but these companies also have a huge, vast number of merchants and vendors and basic consumers that they're dealing with. And if they can integrate stablecoin or products efficiently, then they bleed into the market, and we don't have to like build something from scratch. Like very similarly, look at MoneyGram, for example. Like they have got locations in over 170 countries. All you have to do is walk into any of their kiosks, hand over your cash, and you will have your USDC deposited to your digital wallet. And then conversely, you can send someone USDC, and they can go to a MoneyGram location, and they take out that they cash out that USDC in a local currency, and that's it basically. These are just a few companies that are trying to create or essentially recreate the pre-existing financial network that we have and mold it for stablecoin, right? Because at the end of the day, stablecoin is just a technology that moves money. The problem is we need to figure out the inefficiencies of that process of stablecoins moving money. One of the primary issue, especially with like a retail in the retail scenario with consumer to merchant payments, is going to be chargebacks, right? Because one of the most profound shifts that blockchain technology introduced is this concept of finality. Once a transaction is confirmed on the network, and it's basically it's immutable, you cannot do anything about it until you manually process another transaction back to that wallet that issued the initial transaction, right? Merchants, finality is obviously a powerful feature. The traditional card payment system that allows for chargebacks, right, where a bank can reverse a transaction at the customer's request. Now it's intended as consumer protection, right? But the system is obviously abused, like through friendly fraud, where a customer falsely claims that the transaction is fraudulent or whatever, and then there's a chargeback. Now, chargebacks are obviously a significant cost to the merchant. It's like every single issue can cost you like $20, $100. I don't know, whatever amount that is. But with in the crypto world, you cannot have a chargeback system. Like once a transaction is final, it's final. however legitimate your concerns are, that it was a fraud, that the product you received is not like whatever it was intended to be, like, or you don't like it, whatever. Like, there isn't an efficient way for a consumer to ask for a chargeback, or for a merchant to process a refund. Like, otherwise, outside of manually going and issuing an additional transaction. Now, how do you solve that problem? There are obviously different companies trying to solve it in different ways. For example, Circle has proposed a refund protocol, which is basically a payment that is not directly sent to the merchant, but it's held in this smart contract escrow system for like a predefined period of time, let's say 40 days, for example. And if a dispute arises in during this window, someone like a neutral, mutually agreed upon arbiter will come, and they will take a look at the situation, and they will make the final decision. Either the payment goes back to the customer, or the payment gets processed to the merchant. But I actually think it's a pretty inefficient method, especially whenever you include third parties into a decentralized system. It has to end badly, because like then this third party ends up with all the leverage, right? For example, in a when you are shopping in Amazon, right? What happens when you want to return something? Amazon itself processes that payment, processes that refund. I think that should be the case in general, where like if you are interacting through Shopify, or you are interacting through Stripe, what needs to happen is Stripe or Shopify themselves have to become the arbiter of truth and determine what is right and what is wrong. And then that's basically the only way where I see this chargeback system being resolved, like this chargeback dilemma being resolved once and for all. Outside of that, I think this is pretty much that I need to discuss on this topic of distribution. So, like, if you want to look at the emerging competitive roadmap, or basically the map in general that we have of like consumers to merchants to payment processors to like general financial entities, like there are different layers. From where I stand, I think let's say 5 layers. Layer 1, you have got issuance and regulations. Like, for example, Circle, Tether, Paxos, they are the guys dominating in this layer. They're issuing the stable coins. They're following the regulations, Genius, Mica, whatever it may be. And then you have at layer 2, you have got network and distribution, which is Visa and Mastercard. They are processing the payments. Layer 3 is merchant and developer experience. Like, this is how the network processor, like payment processors, are interacting with these merchants. Stripe, Shopify, Coinbase Commerce, whatever it is. And then once the payment reaches these merchants, like if once this payment reaches Stripe or Shopify, there comes the orchestration and custody people like Fireblock and other, I think, wallet as a service provider, if you want to call them that, who will store whatever amount of money that is moving into these platforms. And at the very end is you have the liquidity and routing, where DeFi protocols like Curve, Jupiter, Ondo, where these people come in, where if you want to basically store your stablecoins in these DeFi platforms for an additional amount of yield, you can do that. So yeah, this is pretty much the 5 layers that we are interacting with. Now, who wins and who loses in this scenario? Like, once stablecoins become the prevalent method of payments, who loses? You have got the middlemen, like the direct P2P and P2P stablecoin payments. They will completely bypass card networks. But since bypassing, since we are not discussing a bypassing of the card networks, especially with like Visa, Mastercard, and already dominant card issuers, what we'll be looking at is people who are like taking a commission of the like taking a fee of from the foreign exchange transactions, from cross-border fees. Like, these peoples are going to lose a lot. Then you have got people who collect float revenues. Like, when you are moving money for 2 to 3 days between different banks, there will be people who hold that money in the between for a day, for 12 hours or something, and they, within that short period of time, they can earn an interest based on the fund that they hold in transit. So these people are going to lose out a lot. as well. And so who wins primarily? Like, in a world of like real-time on-chain finance, the people who can provide efficient if who can basically efficiently manage liquidity, these are the people that becomes the core generators of value. So like this can be DeFi liquidity providers, this can be sophisticated market makers, and this basically platforms that offer advanced treasury management system, because money is extremely liquid at this level. And then you have got compliance people like because with Genius, Mica, people in Hong Kong, China. And so there's going to be a lot of new regulations coming in, and people who understand that regulation and can play with these regulations are going to be in high demand. And then you have got the abstraction and the user experience. As the underlying technology becomes, let's say, commoditized, the highest margins has to be captured by platforms that can basically make the stablecoin experience itself almost invisible. You are just moving money from point A to point B. You don't need to know like through what method, what blockchain, what token standard the money is going through, as long as like payment is being processed from point A to point B. So if you can ensure that level of smooth user experience, you're going to make a shitload of money. So yeah, that's pretty much where we are in terms of stablecoins going mainstreaming via existing rails.